the ship's stabilised. I think there are two things here. The first is that Keir Starmer is absolutely committed to staying Prime Minister. He's sort of like someone who doesn't quite know how to drive the car but knows how to keep the doors locked. And then there's the second issue, which is timing is important in politics. Labour seem to be mystified and terrified of the bond market in equal proportions. And so I think with inflation still a little bit elevated, the economy sort of improving, but still there are some question marks. I don't think there are enough supporters of the potential contenders to try and nudge him out of the way. And so I think it's an uneasy balance for now.
So what do you think the markets, in particular the bond markets, would prefer? A slightly precarious Keir Starmer still in office, or a complete shift and a change and someone else coming in?
No, I think the bond market would prefer Keir Starmer and Rachel Reeves. Actually, by the way, that's still my base case. It's been my slight base case through this. I know we have a by-election coming up. We also have the May elections. But by the time we get to May, my bet is the economy will have improved, and recent data have basically consistently surprised to the upside. The economy sprang back to life since the budget. Inflation will be close to 2%. I suspect the Bank of England will have cut in March. So you have three good economic stories, plus falling immigration. Labour will have passed various bills. And Starmer will be able to say, at least with a half-straight face, actually, the medicine is working. And I think the thing that Westminster doesn't understand that markets do is that when it comes to fiscal policy, the issue for an advanced, rich country like the UK is not the debt or the deficit, it's inflation. The UK is an inflation outlier. That's why we pay the premium in the bond market. It's not an outlier on debt or deficit. So once inflation gets back to 2%, which I think is basically assured within about 3 or 4 months, this big headache from the bond market is going to be relieved. And I think Starmer will be slightly surprised at just how much bond yields come down. Labour will be too, and they'll say, well, actually, this is a Prime Minister that is now pretty safe for a while. So I think he squeezes through.
Kallum, you talked about a bit more of a more positive economic outlook that may help Keir Starmer somewhat, and you're also talking, but we've got a lot of domestic political uncertainty in the run-up to that. And my question is around, if your clients, are they asking you about this uncertainty? How does that impact your economic outlook? How does it impact the Bank of England? Because if you think about it, we know that if there's uncertainty, that can depress demand. So doesn't that perhaps change the outlook going forward, despite maybe what you're saying is better data if we start to see demand come down? And how do you think, do your clients ask you about how that impacts the calculus of the BOE when they cut? Because it's the timing of the rate cut. Do they cut before, or do they wait and see how it plays out?
Good question. So first, just to be clear, my view is this year the economy will do better than the market expects, but it will do less well than its potential. So potential is probably around 1.6, 1.7. I think will be around 1.3, 1.4. The market thinks 1%. When we discuss uncertainty, it's important to understand uncertainty is always present. It's a specific type of uncertainty that markets don't like. So general uncertainty about multiple scenarios at uncertain time horizons can be factored into things like interest rates. And we see that in the UK curve already. That's what that premium reflects. Then the uncertainty that markets really hate is what I'd call event horizon risk, which is where we know a date in future when something may change. And at that point, if those 2 or 3 outcomes following that date do not sufficiently overlap, we're all induced to just wait and see for more information. With the Brexit vote and the delays, we got event horizon risk, rolling event horizon risk. When we announce a budget, we get event horizon risk. And so the fact that we've avoided a leadership challenge to Starmer, which would have put on our calendars a new date for when we find out who leads the Labour Party and then which policy direction it follows, we've avoided the event horizon risk. So yes, does this general uncertainty degrade economic performance? Yes. Do we have the type of event horizon risk which puts the economy on stall until we know what the world actually looks like? No. That's the second type of risk which I'm most concerned about and which clients are.
But I'm delighted that the savvy British consumer stroke electorate are doing the smart thing. They're saving more money. They're thinking about it. It's not necessarily good for the economy, though. That's the problem. We're saving money like we haven't saved for a long, long time. Double-digit savings levels in the UK compared to the single-digit as well, because they are very concerned about all of the above that you three have spoken about as well. But because we're a consumer-based economy like the United States as well, we need that consumer to go out and start spending money. If I was that consumer, I wouldn't be spending money.
Yes, I mean, the UK economy on the private side looks like a coiled spring. Businesses have great balance sheets, consumers have great balance sheets, the banks have great balance sheets. Once you get some confidence into this nice technology cycle, things can actually look pretty good if policymakers, of course, get it right. I think uncertainty plays a role in the increased savings rate. I think what actually matters more is the UK household sector in aggregate suffered a huge hit to its net worth in 2022, which has not recovered. We've had prohibitively high interest rates, which have held back housing, domestic equities, the bond market.
Have you not seen the headline? You probably wrote about it. UK house prices at record levels. Forget about the shishi people living in West London or everywhere else. UK house prices record levels.
Asset prices adjusted for purchasing power, that is adjusted for inflation, are materially lower. Households are rationally responding to being poorer by saving more, which is why these higher interest rates are such a headwind. If we could get interest rates down, the discount rate in markets would help equities, bonds.
High. UK interest rates, they're not high.
I would say the UK...
You're the oldest out of the three of this lot, but you're young compared to me. You're young compared to me, and you're definitely young compared to me. I had my first mortgage at over, 7, 8% in the late 80s.
Let's do some quick maths. So this rule of thumb, the bank's inflation target plus normal growth is roughly where 10 years should be if markets are confident that policymakers have a commitment to sound money. US potential growth, around about 2%. Fed targets 2%. What's the 10-year today?
No, 10
around
years,
4.
About 4%. Yeah.
Right. Okay, Eurozone, potential growth 1%, inflation target 2%. Where's the Eurobond? What's the average of France and Germany? 3. What's our potential growth? Let's call it 1.5%.
I'm going to say 4.5% is the answer.
We should be 3.5%. We're 100 basis points higher than we ought to be. And I think as that inflation rate comes from 3.4 back to 2%,
which it's going to do.
Which it's going to do, the market will give up at least half of this premium. It won't go fully there because there should be justified concerns about this government and its policy outlook. But once we get sub 4%, you'll start to see an improvement and the savings rate will come down.